Good morning, ladies and gentlemen. So, from the standpoint of risk, we are reaching some clarity. We closed at 34. We are still in a weak trend, basically on the borderline between buying dividend stocks or short maturity bonds and adding to balanced growth equities. We are nowhere near. I've looked at all the spreads and all the indicators, and we're nowhere near to being pushed into the purchase of aggressive growth stocks and ETFs and avoiding bonds. Absolutely nowhere near, a long, long way away. But what we have seen is good enough to turn every single model into risk on from risk off. And once again, what does that mean? That just means that you are looking on every dip in the market to get to your maximum risk position. So if your maximum risk position is 75% or 80% in equities and the balance in bonds or something else, that is the allocation that you are striving for on dips. This is not a mechanical model which says you have to be invested in stocks and not at all in bonds. It just gives you the tendency towards which you should be aiming, i.e. you should be over-invested from your median level in equities rather than in bonds. So at the moment it's saying we are reaching clarity. The risk reward is in being long in all time frames of equities over bonds. What are the various deviations telling us? Well, they're telling us that the market is very close to a top. It closed very, very close to it on Friday. The red area starts here at 306.59, and basically we closed at 306.1. The market has very little upside. It needs to spend a considerable period of time churning around at these higher levels before it can start moving higher. And I will show you in a few slides why that is. The risk reward up here is not to be long of equities, but it is to be short of volatility. Whatever sector we look at, we see that the major sectors are very close or in the red area, but they're pointing upwards. XLU actually is the one that is telling you the story. Everything is contracting, and XLU as a proxy for bonds is saying that it's going to go nowhere over the course of the next few weeks or even months. If that is the case, as I've shown you in previous videos, the stock market basically is being supported by the yield level of the treasuries. At this low yield and not moving, i.e. the Fed having injected stability into the bond market, it is terribly unlikely that we can have a deep sell-off in equities, even though we are overbought, because they yield more than treasuries, and therefore on every dip there will be natural buyers of equities. That having been said, the major sectors like XLK are very overbought and into the red. They are likely to, at the very least, stay at these levels for quite a while, if not come back. And then we have XLF very close. The one that I thought would lead this because of the steeper yield curve is going to encounter resistance very soon, and you can see from these periods that even when it goes up, it's a full storm. It comes back eventually, sort of within a month to the middle line. Everything though is pointing nicely higher. Everything, all the middle lines are showing an upward trajectory. XLV is very high. Avoid it. And even P is very neutral, and it's saying that it's not going to go down in a hurry. So people are now willing to go from defensive to more growth, but that move is not going to be a huge move for the price of equities, but it could be very significant in terms of how much lower volatility, realized volatility, is in the next few weeks. I have here enlarged the chart of the Blue Angels because I wanted you to see the slopes. You can see how the slopes of them have basically been stationary for the past several months, and the market has basically oscillated between times 16 and times 17. Can it get to times 18? Of course it can. Excuse me, but it's very unlikely to get there in a great big hurry. The slope of the Blue Angels just does not allow it. We are now over halfway through the earnings season. We know with almost certainty what the final figures are going to be for the S&P as a whole, and that just does not allow for very fast movements upwards. So really it's all falling into place. What the Blue Angels are telling you, what the deviations are telling you, but also what risk is telling you, and that is that we are in risk on. If we look at the SPX chart and apply what we have seen in deviations and what we've seen in risk and what we've seen in the Blue Angels, it makes perfect sense. On a monthly basis, I think we will be trading somewhere between this blue line, 29, just below 3,000, and the very considerable barrier of the Bollinger Band, which is 31.14. So that is basically a 3.5% range, which again is going to give you a much lower realized volatility level for the month of November, with an upward bias for prices. So you're talking about buying the dips down towards the 3,000 level. We saw how hard it was for the market to break the 30-20 level. Just couldn't do it. 30-20, 30-15, there was a wall of buying there, and I think there will be a wall of buying there again. But on the other hand, the market just does not have the oomph yet to break substantially higher and keep on going. I think we are likely to have this kind of pattern over the next few months. So basically a market which goes up by 4 or 5% over the course of 2 or 3 months, giving you a very low volatility environment. On a weekly basis, you can see what we've done. We've touched the top of the Bollinger Bands. If we go back in time, it is very rare that the market actually stays above the top of the Bollinger Band. Very few incidents of that happening, where the market didn't just go sideways afterwards. I think this is a perfect simile to what is going to happen here. There's going to be constant upward bias, all the dips being bought, letting time go by and allowing for this trend to develop. If the trend is going to develop to the upside, the surprise might be that November and December are so quiet when everybody's expecting big things from them in terms of upside. I am not. I am expecting big things on the downside in terms of volatility. This is a daily chart of volatility, and as many of you will know, I'm a firm believer that volatility trades in ranges, and that different ranges mean different things for the market. And volatility is a great predictor of what the market is going to do. At the moment we are going towards the bottom of the trading range, that is between 11.30 and 16.25. I am of the firm belief that we will break it, and we will go to the lowest range that we have ever seen, which bottoms out around 9%. I think the difference between the realized volatility of the market and what the current pricing is unsustainable. And over the course of the next couple of months, we will see volatility break down below 10%, down towards the 9%. Now, that is a huge move in volatility. That's like a 30%, valuation move. And on top of that, we have such a steep yield curve in volatility. So selling the first months is a much safer trade. If we are correct in the view that the monthly shows you the range that is likely, the risk is risk on, people will be buying all those dips. If we have those upper ranges in SPX set, it is almost a given the volatility needs to come down a lot. And therefore, selling something with a steep yield curve and just riding it is much safer than being long of the market. Why do I believe in the low volatility thesis in equities? Simply because I now believe in a low volatility thesis in the bond market. And as I've shown you in previous videos, I firmly believe that the level of yields is extremely supportive of the equity sector. This low and stable level of yields, with the yield curve probably hardly moving until year end, with the market not knowing whether to anticipate further cuts or not, but being comfortable at these levels, to me indicates that the 2-year note will basically trade for quite some time in this 170 to 148 kind of level. If it starts breaking below that level, I think the odds of it breaking higher are very low. The odds of it breaking lower are higher, but that would need to come on the back of some data showing some kind of a weakness developing in the US sector, which we just haven't seen really for the past several months. We have seen a manufacturing sector which has been getting slightly weaker on the back of world trends, but we haven't seen a service sector which has been weak in any way. And really the sales in the last quarter of the year are likely to be very good, simply because employment is very strong, wages, there is wage growth, the consumer is not over leveraged, if anything they're under leveraged, so there is no reason to expect that the Fed will be rushing to cut rates anytime soon unless there is some real data. And I don't think we're going to see any real data for quite a while. I think the 2-year sector is the 2s and 5s actually show you what is likely to happen here for a long time. And if yields don't move, it is very unlikely that volatility can pick up in the equity sector. Well, I'm going to show you just the 5s as well as the 2s because it's so clear what is happening. We are repeating this section here. And if you have a look, don't forget these are weekly bars. If you have a look how many bars there are here in this little trading range, this is almost a whole quarter of trading in a 15 basis point range. What does that mean? What does that imply? Fed on hold, market goes up a little bit, goes down a little bit, goes sideways, does nothing. That is not what volatility is built on. That is what stability, boringness, everyone's happy, it's a Goldilocks scenario. And what happens, you have, in that scenario, you just don't have volatility at 17-18% in the back months. You have it down at 13-14%. And that is a huge move. That's 30% that you can still make over the course of the next, month and a half. So to me, the obvious trade here is to sell equity volatility, because the volatility in all the other sectors is absolutely anchored. I also wanted to show you a couple of charts of the Nikkei and the DAX. As you know, I've been more positive of the Nikkei than anything else, and on Friday it actually reached my level 23,005. I think that is a very important level, and I think the likelihood is that we do something that we did here in this area. I basically can see these are weekly bars, okay, so you can see how many weeks we spent trying to break through it. That's 1, 2, 3, 4, 5, 6, 7, 8. That's 2 months before we actually broke through it, couldn't hold it and went back down, but that's a completely irrelevant to my thesis. This is a very, very important level for the market, this 23,000 level. So it's very unlikely to me we're at the top of the Bollinger Bands. We are not going to have an easy time breaking through 23,000 and just going on. We're going to need some sideways pattern here. And if the market that I'm most bullish on, which is Japan and DAX, and which I'll show you in a moment, are going sideways, it's very difficult to believe the S&P is just going to keep on trucking. There's absolutely no reason for it. So more ammunition to my thesis of low volatility, which is going to surprise people, because people are getting very bullsed up right at these levels, which to me makes no sense. We are so far above the Blue Angels. We have completely different monthly and weekly Bollinger Bands telling you that we're not going much higher. We have the deviations telling you the same. To me, it's all falling into place. You do not bet against those kinds of odds. You are not long of SPX, you're short of the volatility of SPX. And here is DAX. As you can see, both the Nikkei in the previous slide and the DAX have much steeper Bollinger Bands than the S&Ps. Go and have a look at the slide that I posted, or do it on your own system, but you will see that the slope of the Bollingers in other markets like EM, like DAX, like Nikkei, which I prefer to SPX at these levels, are much steeper, which tells you that the potential for acceleration in those markets is greater than in the S&Ps, which makes fundamental sense, doesn't it? If everything is anchored and you know a level of yields that is persistent at the moment, you can actually allocate to the highest yielding markets with much more certainty, and therefore you can make the divergence between the S&Ps and those markets smaller. To me that makes sense, but even the DAX to me is going to crawl along this top Bollinger Band, and it's unlikely to move more than 0.25%, 0.5% between weekly close the week before and the weekly close of the week after. If that is the situation, everything, but everything I look at is pointing towards low volatility. I see little point in endlessly repeating the biases. The basically 2s and 5s are doing exactly what they should. That is anchoring all of these markets, the SPX, the NQ, the European equities. So really my one conclusion from everything that is happening here is VX, ride that curve. Seller of Novembers, Decembers, Januaries, it's all going to go much lower, I think, over the course of the next 6 weeks. I think by the time we get to Christmas, we could be in single digits in volatility, and that is a very, very big move. That is all I have to say. I think that's the safest thing to look at for the foreseeable future. Thank you very much indeed, and tweet you on Monday.